So we were talking about executory costs, and we mentioned that these are those incidental costs associated with owning the asset and whether the lessee pays them in the payments or they pay them as an amount that's variable outside of the payments. These have an important issue that's not really fully discussed in the text. So I want to make sure that I cover the new standard on these costs. So let's read again. We went over this before, but these include the ongoing support costs for the leased assets, such as insurance, maintenance, property taxes, and third-party guarantees of residual value. Third party. So the lessor could, instead of having the lessee be responsible for the lease payments, and for reasons that I can't really specify, but it's possible, they would hire an insurance company to go ahead and guarantee that residual value. So that can be a required payment by the lessee as well to that insurance company. So it says economically such costs are passed on to the lessee by the lessor one way or the other. And I'd mentioned that a gross lease is if those executory costs are included in the lease payments, then they're going to be treated as part of the lessee's liability. And the net lease is one is if such amounts are variable payments to the lessor that is not knowable at the lease commencement, or if the lessee pays a third party directly for these costs and they are excluded from the lessee's liability. Okay? And they're going to just be expensed as incurred. So there are a couple things here, comments that I make. First, the lessee would have to know, and we talked about this, it might have been a subtle point that you missed. The lessee would have to know how much of the lease payments, if any, are covering executory costs if the lessee were to try to determine the implicit interest rate. Make sense? Because the implicit interest rate by the lessor is only recovering the asset value. It is not recovering executory costs. So the lessee would have to back those costs out of the lease payments. They'd have to know what they are in order to do that, in order to find the internal rate of return on the lease, which is the implicit interest rate. Okay? The other thing is very interesting here about GAAP. You guys remember something called asset retirement obligations from last semester? Okay. So when you have an asset retirement obligation, such as maybe you're putting up drilling rigs in the ocean, and you sell that to a buyer, and the buyer is going to be responsible then for tearing it down, restoring all of it. Well, that could actually cause the asset recorded value to exceed the fair market value, because you're taking the present value of those asset retirement obligations and adding them to the asset cost basis, right? Then the same thing happens here. As I mentioned, by including such costs as part of the lease liability, the right of use asset may be inflated on the lessee's books relative to what, in historical cost accounting, we record these the assets at their fair market value, correct? So this could cause that recorded cost to exceed the fair market value of the asset. You with me? Okay. So assume the same facts as in Exhibit 21.2, except that the lessee knows the lessor adds $3,200 to the annual lease payments to cover insurance and scheduled maintenance of the equipment. So now all I'm changing is the annual lease payment to equal not the original $37,179, but we're adding that $3,200 of executory costs to get the total lease payment now that's under obligation by the lessee to $40,379. And it says, prepare the entries for the first full year of the lease. So what interest rate would the lessee use? Well, we know it's incremental borrowing rate from the original problem. But could they figure out what that rate is now, if they know what executory costs are included in the lease payments? So they know the lease payment is $43.79, correct? And they know the fair market value of the asset is $160,000, going back to the original information. So because lessee knows 3,200 is included in the payments, or in the lease payments, they can compute the implicit interest rate. Okay? Well, how? Well, again, we would do the same thing we did before, where we set equal to $160,000. Whoops. Doesn't look like $160,000. The capital lease payment that excludes the executory costs would be $40,379 minus the 3,200. So it would be back to the old 37,179. See? You getting this point? So, and they know the lease is for 5 years. Whoops. So, present value of an annuity, 1 plus I to the negative 5 over I. Annuity due. And what else would they add to this? The residual value, okay? So the residual value is 8,000. And so if you set your calculator, let's go ahead and do that to the begin mode. And you just put in what you know. Always clear the registers, remember? And so what do we know? N is 5, right? We're looking for I, so I'm not going to do anything with that yet. We got a payment of how much? 37,179. You could make that negative, but you'd also have to make what else negative? That future value, 8,000. I'll just make them positive. And on the other side of the equality, that number has to go in as negative. And for what? Present value. So if you do that and you hit I, what do you get? Do you? What do you get? 10. 10. You should get 10. So it's 10%. So I is equal to 10% in this problem. So the lessee could still determine that implicit interest rate as long as they know how much of the payments are executory costs. Yeah, Maya?
So why is there any difference between the way we did it the first time?
There isn't really. It's just that I've changed the problem to add executory costs to the payment to make them $40,379 now instead of the $37,179. But I'm saying that the lessee also knows how much, specifically $3,200, is executory costs. So do you see why the lessee would want to pull that out of the executory costs out of the payment to compute the implicit interest rate in the lease by the lessor? Okay. So as long as they know the executory costs, again, they can compute that implicit interest rate, and that's what they would use. You follow?
But even if like they didn't know it, you subtracted
Well, if they didn't know it, they couldn't subtract it. So we're looking at the world from the lessee's standpoint. If they don't know what that executory cost is, they couldn't subtract it out of the lease payment. And the executory costs aren't recovering the value of the asset of $160,000. It's only, yeah. So,
But you already know the lease.
yeah, so the lessee would know the lease payment. Now, let's say they didn't know that the executory costs were in there. Okay? Then they could, my point is, they could not figure out what the implicit interest rate is by the lessor. They would not be able to do that. They have to know how much that executory cost is in the payment before they could figure out, like we've done before, the implicit interest rate. Now, does it make sense? And everybody else? Okay. Yeah, Cole?
Sorry, under what circumstances would the interest rate in 21-2 be different from the implicit rate that we just found?
You mean the implicit interest rate be different? I haven't changed that. I'm just trying to discern what it is from the lessee's standpoint. Okay? So, go ahead. So that's the point. If the executory costs were unknown, the lessee would have to use their incremental borrowing rate instead, because they wouldn't be able to determine the implicit interest rate. Okay? Now, we have to determine what the present value of the lease payments is for the lessee. If you go back in the notes, it says the lease payments include all fixed amounts, including executory costs. And that becomes part of the liability of the lessee. So we just did something where we figured out the rate for the lessor is, but now we have to figure out what are they going to record as their liability and related asset on the lease. So I'll say, but the present value of the lease payments to the lessee is as follows. So they discount the full lease payment because it's fixed. So they're going to have to discount the $40,379. And this is new under GAAP. It didn't used to be this way. They would exclude those if they knew them. But now we go ahead and capitalize those fully. And we're going to use a 10% discount rate. Annuity due. Is there anything else that they would add, going back to the original problem? We're 3 days on this problem now, basically. Yeah. That's right. So they remember that the lessee thinks the asset is going to be deficient in terms of the residual value by $2,000. You recall that? So the rule is that if there is an expected or probable amount that's deficient in covering a guaranteed residual value, which was our original problem, and then that's also included in the lease payments. And that's brought back 5 periods. Well, you could go ahead and solve for this in your financial calculator, just putting in all the parameters. And what you should get is $169,617. Now that's more than we got before. So notice that 169,617 exceeds the fair market value of the asset of 160,000. So just like asset retirement obligations, this sort of thing can cause an asset to be booked for more than its fair market value. You know that from GAAP, that typically we're talking about the arm's length transaction and the acquisition of assets. It's at fair market value. but now it's going to result in that asset be recorded for more than fair market value. You follow so far? Okay, good. So on 1/1 of X1, we'll make a compound entry to record our asset. Let's just go ahead and debit the asset account. Credit, we know the liability is 169,617. But don't also forget the other things that were going on in that original problem. The lessor paid the lessee a rebate of $3,000, but the lessee had these initial direct costs they had to pay to the attorney, and so the cash amount that we have of $3,000 minus the $1,500 was an adjustment to the asset cost, okay? So we'll just go ahead and plug for this asset cost, which is 168,117. Cash amount is $1,500. Yes, Cole?
Just want to clarify that the 2,000 in calculating the PV of lease payments is coming from the difference between the residual value of 8,000 and the full value of the equipment, which is 6.
Yeah, so the question is, to clarify the $2,000 up in this calculation here. Yes, the residual, what was guaranteed at 8,000, the lessee only believes it's probably going to be worth 6,000, so that's the deficiency. That's the guaranteed residual deficiency, the 2,000. Okay? All right. What else happens on this date? They make a payment, okay? So reduction of the lease liability. Credit cash. How much is the payment going to be? $40,379, right? So those would be the entries by the lessee on 1/1. And I ask you for the entries then for the first full year of the lease, at last sentence of the problem there. So we have to go to what's the next date? What would be the next date? 12/31, right? 12/31 of X1. And they record what? Interest expense. Now, I didn't provide an amortization schedule, but this is the first interest expense number that would be in it. So we know the liability initially started at 169,617, but we made an immediate payment of 40,379. They would use a 10% interest rate because they figured out the implicit rate. And it's a full year. So that amounts to $12,294. That increases the lease liability. Remember, we don't use interest payable. We're going to go ahead and increase the lease liability directly. $12,294. And that's one adjustment that has to be made. Any others that have to be made? Depreciation / amortization of the ROU asset. So in the standard, they call it amortization expense. To be consistent, we'll do that. And based on what cost? Based on what cost? the 160, what do they have in their books? Yeah, this 168, 117 is what they booked the asset for, so that's the amortizable amount. 168, 117. And they don't use residual value to depreciate or amortize. We're just going to amortize this over how many years? 5. Okay. 33,623. Do we use an accumulated depreciation account? No, you don't. So you reduce the ROU asset directly. 33,623. Now, next day, 1/1 of X2. What happens on that date? It's the anniversary date of the lease. They make a payment. So what do we debit? Lease liability. Credit cash. 440,379. Get the idea from the lessee's standpoint? Well, what would the lessor do? I don't ask for that in the problem, but let's just talk about it. And the book certainly doesn't get into this. Well, the lessor would also find the present value of the lease payments as the lessee did with the 40,000, what was it, 379 amount, rather than that 37,179 amount that we were talking about earlier. So the lessor is going to have a lease receivable that is also overstated relative to the value of the asset they're taking off their books. You got it? It would be a wrong thing then for them to record that difference as a gain, because it's really going to be due to executory cost payments back to the lessor, correct? Okay? So that's like another performance obligation under the revenue recognition standards. They wouldn't treat that as a gain on the date of lease inception. What they do is they'd get those payments in, treat them as, well, they'd have the receivable, it'd be recorded at interest revenue on the whole thing, but also that amount that is received as the executory cost is going to be treated as a revenue item to them. Okay, as they make the payments that have that additional executory cost in it. And then when they pay those executory costs, it's going to be an expense. I'm not going to test you on that little tidbit, but that's what would happen. Would it be helpful if I put it in the notes anyway? All right, so why don't we go ahead and write something like that down? Lessor would include the executory costs in its lease receivable. But it would remove the present value of those executory costs from the determination of the gain or the gross profit that we had on the asset. I'm going to say in general gain, there could be a loss, but we don't have that in this problem certainly. But it would remove that from the determination of the gain or loss and instead treat it as a performance obligation under the revenue recognition rules. Okay? So it's in your notes. Highly unlikely it's going to be, it's not even talked about in the standard. You have to know the revenue recognition rules. They say previous guidance or other guidance in the standards. But I just thought, because my mind took me here. What would the lessor do? And they couldn't include those as part of the gain or loss because they're not a recovery of the asset value itself. You see, it's just a performance obligation that's contractual under the lease to make those executory payments to, what did I say? It was for insurance and maintenance, right? All right, so it would be treated as revenue then when they receive that extra amount, and then expensed when they actually make the payments for the executory costs. Okay? Can you read this all right? All right. One last issue. The lessor could have two types of capital leases. We said the lessee only has what's called a financing lease, if it's a capital lease. But the lessor could have either a sales type lease or a direct financing lease. The general rule was, as we went back, if you go back in your notes and reviewed these, the general rule is a sales type lease. That is, if you meet the capitalization criteria, one of them, there were 5, if you met any one of those, both the lessee and the lessor would capitalize the lease, and the lease was called a sales type lease on the lessor's side. All right? Now, what is this whole thing about? This is in fact, the standard says this is likely to be rare, but they closed a loophole on this. If a third party guarantees any of the residual value, they would have to go ahead and include that amount in their receivable, or what we're going to call the net investment in the lease. Okay? Whereas the lessee, I should go back and just make sure you understand what I'm talking about. Let's go back here. It's been a few days we've been working on this problem, and I can see a little confusion in the eyeballs, so let's go ahead here and look at this. Actually, it goes back up here. Present value test. It says, and these were the criteria. So the fourth one, it said the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already reflected in the lease payments equals or exceeds substantially all of the value of the underlying asset. Well, what if it's guaranteed by a third party? And it's not in the lease payments. That is, lessee isn't reimbursing the lessor for this. So that's why it would be rare. So they call this a direct financing lease if it's not a sales type lease. So let's go through that. Gosh, a lot going on here. A lot of moving parts. Don't you find that in this chapter? A lot of moving parts in this chapter? Yeah. A lot of moving pages on my screen. All right. So, direct financing lease. Under a direct financing lease, any profit is going to be deferred and amortized over the lease term. This is because a third-party guarantee of residual value means control of the asset has not really been fully surrendered to the lessee by the lessor. In the event of a loss, it is recognized immediately. So if they have a gain, they're going to defer it. We're going to see how they defer it. They're going to amortize it. But if they have a loss, here's another example of conservatism still finding its way into new standards, even though it's not part of the conceptual framework. If they have a loss, though, they recognize it immediately. Okay, another nuance. I don't know why they took conservatism out of the conceptual framework if they continue to use it. Now, what you have in the conceptual framework was representational faithfulness, right? Free of bias. And so they didn't want conservatism to be in that because that would be a bias. Well, here it is. You still see it. There's a brand new standard. Now, lessor's initial direct costs. That's also different if it's a direct financing lease. The incremental cost of a lease that would not have been incurred if the lease had not been executed. So these are, on the lessor's side, things maybe they have to pay an attorney as well, and so on and so forth. But it's got to be external costs for this to be treated as an initial direct cost. If you have a leasing department and they put leases together all the time, well, that's an internal cost, and those aren't treated as part of initial direct costs. What do we do with initial direct costs? Well, under operating leases, we just amortize them straight line over the lease term. Under sales type leases for the lessor, we saw what we did. We expensed them in the period of sale. It was like a cost of the sale. So that was already illustrated. But in a direct financing lease, these are amortized using the effective interest method. Remember we used the effective interest method to amortize bond issue costs? Same sort of idea here. And that's best accomplished by including those costs as part of the net investment in the lease to be recovered through lease payments. So I'm going to give you a whole new example now, okay? Because we did the other one to death. Consider the following data for the lessor. It has a fair value of leased equipment of $7,500. The carrying value of the leased equipment on their books is $5,000. The estimated residual value is $2,000, but it says 75% of that is guaranteed by a third party. So none of it's going to be guaranteed by the lessee. They're just telling us what their estimated residual value is, and we're told what's guaranteed, only 75% of it by a third party. Lessor has sales commissions associated with the lease contract of $250. Non-cancelable lease term, 4 years. Economic life of the asset is 6 years. Lessor's desired rate of return is 13%, and the date of the lease is 8/1, August 1st of X1. So determine the annual lease payments required by the lessor. Now I want you to think about this. If you're the lessor, how would you determine what those payments should be on this lease if you want to earn 13% on your investment? So lessee is not charged any executory costs and makes no residual guarantee. I'm making that clear in this problem. Well, what would the lessor do to figure out what the payment should be? They want to recover an asset that has a value of, no, I'm sorry, not 100. We're working with a different problem. 7,500. And they want to get that by some lease payment. They want to recover a 13% rate of return on their investment, so they would use 13% to discount the annuity, whatever it is. But the lease term is what? Economic life of the asset is 6 years, but the lease term is 4 years. Plus, the lessor thinking now, they're estimating a residual value of $2,000 for this asset. Yeah, 75% is contractually promised back by the insurance company, but they're still expecting $2,000 value coming back, okay, in this problem. So the residual value full amount would be $2,000, and that would be discounted back at the 13%. So again, you'd use a financial calculator probably just, now you're solving for the payment since you have all the other parameters. And the payment equals $1,866. So are you with me? That's what the lessor would do to set that. I just wanted to give you another practice here, thinking about what the lessor would do to try to recover the value of the asset of 7,500. So what kind of lease is this to the lessor? So the lessor has those 5 criteria. Remember what they were. Does it transfer ownership at the end of the lease? So that test fails. Fails that test. It doesn't have that. Does it have a bargain purchase option? That's the second of the 5 criteria. Nothing about purchase options at all? Fails. You remember the third of the 5 criteria? 75% test, right? Good. The term of the lease. Well, it's 4 years. The economic life of the asset is 6 years. That equals 0.67. Does that pass the test? No, it's less than 75%. It fails. Present value of the lease payments, the fourth of 5 criteria. Well, you got to think again. What does the lessor do and the lessee do to figure out whether it meets that 90% cutoff of fair market value? They take the lease payments, non-cancelable lease payments of $866, which we already determined. Discount them back 13%. There are 4 of them. Do we add the residual value? This is where you really have to have good memory. Let's go back to that present value test. Right here, the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already reflected in the lease payments equals or exceeds substantially all of the asset value, which we use that 90% cutoff. Well, is this residual value guaranteed by the lessee? No, it is not. It's a third party. So that is not going to be included in our present value as far as satisfying that test. Just imagine what my summer school students are going to do with all this going back and forth. Well, same as you guys, right? We'll get there. So, plus, I'm going to make it very clear, plus 0. Because it's not guaranteed by the lessee. Well, this is equal to 62.72. And as a percentage of the value of the asset, which is 7,500, that's 83%. Well, 83.6%. Does it meet the 90% test? No. Less than 90%. Fails. The last one. Does the asset have no alternative future use other than for this lease? It must have an alternative future use because it's got a residual value. So the alternative use test, excuse me, fails. because it has a residual value. Okay? So it must have an alternative use when the lease is over. That is, they could sell it for the residual value. Okay? So it fails all of these 5 criteria for capital lease treatment. So what does the lessor do? I have to do this again. You go back to the lessor now and you look at the second type of lease, which is a direct financing lease. And it says this: if the sales type lease criteria are not met, control has not been surrendered, the lease is either an operating lease or a direct financing lease to the lessor. We're talking about the lessor in this heading. And a lessor classifies the lease as a direct financing lease if, here's another moving part, the present value of the sum of the lease payments, which included any residual that was guaranteed by the lessee, remember, and any residual guaranteed by a third party unrelated to the lessor equals or exceeds substantially all of the fair value. So we do another fair value test. Okay, it gets wild. So do another fair value test. If it fails the criteria that we have for capital lease treatment, that is for both parties, we go ahead and do another test to see if it's going to be treated as a direct financing lease, and if it isn't, it's going to be an operating lease to the lessor. You guys will be thankful that we're almost done. Okay? So, on the next page, you got room? To make a note. So, does not pass any of the sales type lease tests. For the lessor. Now it computes another 90% test with the third party guarantee. Present value, if you do that, equals the lease payment, $1,866, discounted at 13%, there's 4. Plus, what do you think? All the 2,000? Yeah, just the guaranteed fraction of that 2,000, which was 2,000 times 75% or 1,500. And that's discounted back 4 periods. This, if you compute it, equals 7192. And as a percentage of the asset value, it equals 96%, which is greater than 90%. Therefore, what kind of lease is this? Direct financing lease. If it didn't meet this test, what kind of lease would it be for the lessor? An operating lease. Good.
So if the
less guaranteed energy residual value? Would that be included in here?
Yes, so if maybe the other 25%, but if I had that, it might have changed my 83.6% to be a little bumped up, so I didn't have that happen. But the question is, if the lessee did have some residual value that was guaranteeing maybe 25%, but again, you would have to look at the amount that would be probably owed in their computation of their liability. But it would just include that, all that residual value then.
So it's not just the
Well, it's not just third party. So in the basic lease criteria, that present value test only takes into consideration what is guaranteed by the lessee, okay? And it's the full residual value that's guaranteed by the lessee, right? So that's what we're getting at here. It wasn't guaranteed by the lessee at all. All right. So let's record the lessor's journal entries on the lease commencement date. Now, here's the thing. Any profit that the lessor has on this transaction is not going to be recognized immediately, okay? Because they haven't surrendered control if you have this sort of situation, and therefore they defer that gain or a loss, it could be a loss, where they'd recognize it immediately. But if you have a gain, you're going to amortize it over the lease term using the effective interest method. So that's most easily accomplished by just including that gain in the lease receivable and amortizing it that way. Specifically, they would debit, well, let me show you the deferred profit calculation. The deferred profit is equal to the value of the asset minus its carrying value on its books, which we said in the problem was $5,000. So the deferred profit number is $2,500. So instead of recognizing that as a credit now, what we're going to do is reduce the lease receivable account. That is the debit that we would make to it. The account is called something different here. Now it's called net investment in lease. I would not take off if you just called it lease receivable again, but this is what the standard calls this. In fact, I think the text also just calls it lease receivable. So not to make it confusing, but the standard changes the name of this. And so what's going to happen here, that is going to be including, well, certainly the fair market value of the asset, as it always does, is a receivable. There are initial direct costs that aren't going to be expensed, but they're going to be capitalized into this net investment in the lease, minus that profit that is deferred. And so the net investment in the lease, $5,250. They get rid of the equipment or I guess I'll just show you that it doesn't have to be inventory. It could just be maybe equipment, just to give you an example of that. So the equipment is carried on its books at $5,000. Okay? And they have to pay cash for the sales commissions of $250. Those are in the initial direct costs. Okay? Any questions on that? You'll see what happens to this net investment in lease in a second. So what interest rate will the lessor use to amortize the net investment of the lease? So that's including the initial direct cost plus, you've taken that profit out of there. So our net investment in the lease is small. It's $5,250 relative to the value of the asset. So watch what happens here. We know that if we're figuring out, well, what is the interest rate? We're going to amortize that net investment in the lease, or lease receivable. We take $5,250. Yes? Yeah, absolutely, Sarah. Go ahead, ask.
I thought that $250 was the lessor's sales commission.
Yeah, but in my thinking, it's an external sales commission, maybe you paid to another retail store or something that's leasing this out for you, or that gets the buyer.
Okay, that makes more sense.
Okay, so these have to be external costs. Initial direct costs have to be external, so maybe that's the situation. Okay, so 5250 is 1866, equal to 1866, which are the lease payments, 1 minus. We got to solve for an interest rate to amortize that thing. Plus, they're expecting the residual value to be 2,000 at the end of the lease term. So go ahead and let's put this in your calculator. Begin mode. N. After clearing the registers, I'm sorry, what goes in for N? 4 goes in for N. Yep. Well, it's guaranteed by, partially guaranteed by a third party. But remember, the lessor expects to get the full residual either way, whether it's contractually guaranteed or not. So 4 goes in for N. We're looking for I, so we skip it. Our payment, 1866. $2,000 for future value. And we'll have to put in negative 5250 for the present value. You hit I. Go ahead and do that. Tell me what you get. You get 41.98. That's what that means, 41.98%. That looks ridiculous. So it's not just interest, though, is this? They deferred the gain, and the reason this is so high, they're going to have a lot, they're not going to even call it interest revenue. It's just going to be revenue. But it's at a 41.98% rate to amortize that gain, okay? So we had a gain of 2,500 that's not recognized immediately, but it's going to be recognized over the period of the lease by using this really high interest rate. As it's, I'm calling it an interest rate, but it's really going to be the amortization rate for that net receivable. So get in your notes, the reason this is so high is because it's not just interest. But also effective interest method amortization of the gain. And so what I did is I go ahead and prepared an amortization schedule. You can see this thing resolves using that rate. That's the, what did we say, it was 41.98%? So it calculates to be huge interest payments, which are interest amounts, which again are not just interest, they're gain amortization. So how would the lessor record the entries on 1231X1 and 11 of X2? So we already made the entry here on the inception of the lease. Okay? So what would that entry look like on 12/31? And I actually see an error in my notes, but let's go ahead and fix it. They increased the net investment in the lease by that interest amount. We're not going to call it interest revenue. It's called lease revenue. Well, how much? A full year's amount would be 1421. And what fraction of the year? What's 9/1 on the clock? 9/1 is what on the clock? Beginning of the month, 9th month is the 8th, right? So how many months are we talking about here? Oh, you can count your fingers. Tell me how many months. From the 8th to the 12th? 4? Right? Okay. So 4 12s. Somebody calculate that amount for me, because that's the year in my notes I see. Yeah. So it would be, it was 8/1, I'm sorry, it wasn't 9/1. You're absolutely right, I was about to make a mistake. 5/12. Go ahead and calculate that amount for me, if you would. Thank you for catching that. 8/1. It's the 7 on the clock. Okay, you get what? 592? Does everybody get that? I just need a corroboration.
Yeah.
You okay? 592. And 592. And what would they do then also on the next date? I should probably say here, well, on 1/1, I see that I have to rework these notes. So we wouldn't do anything until when? Next entry for the lessor would be next August 1st, okay. So let me cross this out and leave it at that. Sorry, mistake in my notes. How many mistakes have I had in my notes? None. No, there's been a couple, okay.
So are the lease payments always on the anniversary?
Yeah, the lease payments are always on the anniversary of the lease.